Hello, welcome. Apologies for our slightly late start. Welcome to the first BetaShares webinar of 2020. We'll be talking about diversified ETFs, the all-in-one investment solution. I'm delighted to be hosting the webinars again this year. My name's Sarah Hare and I'm the Senior Marketing Manager here at BetaShares. Hopefully those who attended webinars last year will appreciate the program. We've got a full session for you today with some interesting and informative content. So before we get started, just to let you know that a session recording and presentation slides will be distributed to all registrants. We'll hopefully have this done by the end of today. On your screen, there should be a widget where you can ask questions, and if you have any questions throughout the session for our hosts, please feel free to use that and we will answer the questions at the end of the session. Just to remind you that anything we do talk about today is general in nature and does not constitute personal financial advice. We always recommend that you do seek your own advice before making financial decisions. There is PDFs available on our website for any of the products that we talk about. Hopefully most of you are familiar with BetaShares, but just a slight introduction. We are an Australian ETF provider. We have 60 funds on the ASX and just over $10 billion in funds under management. We have funds covering all asset classes, and our four most recent funds that we'll be talking about today are multi-asset diversified ETFs. Joining me today will be David Bassanese, our Chief Economist, and Alistair Mills, Associate Director from our Portfolio Analysis and Advisor business. The agenda today will be covering the importance of a diversified portfolio, the benefits of using ETFs, and then going into our BetaShares Diversified ETFs range. So before we start, I'll just pass over to David and he can begin the session.
Thanks very much, Sarah, and thanks to everyone for tuning in, and great to be with you for another year, another likely eventful year again. And so, yeah, I'm going to go through the first two parts of the presentation before I hand over to my colleague, Alistair. So firstly, just to set the scene, you know, why have a diversified portfolio and what do we mean when we say diversified portfolio? And just a couple of comments along this. I mean, the first slide here is a quote from Ray Dalio. You may know of him as a billionaire investor, but because a bit of a you know, he says, as he says here, you should have a strategic asset allocation that assumes you don't know what the future is going to hold. So you need to have a range of different type of assets that can perform differently in different economic circumstances, so that, you know, irrespective of what may happen, you know, you're not going to sort of blow up. Some things may do not so well, whereas other things will do somewhat better. So that's a more the sort of academic approach to it, the strategic asset allocation. Another way, I guess, a more layman's term would, as we see in the second slide, effectively boiling that down. You know, boiling that down to a, you know, more, you know, don't put all your eggs in one basket. I think that's the, you know, the key message of today's presentation, and, you know, the key advantage of the ETFs that we'll be talking about today is the fact that it does allow you to spread your risk and have different eggs in different baskets. And this is through having diversified access to different asset classes. And again, a big part of the presentation today is to explain this concept of an asset class. As we've seen in this slide, what is an asset class? So basically, an asset class is a collection of securities, be them like, for example, company shares or a group of government bonds or corporate bonds that have similar risk and firstly, they have similar risk and return characteristics. So the likely return over time from a collection of equities, you know, will give you a certain type of return, and it'll be typically higher than what you would expect from, say, cash or from and bonds, but also risk, and that the volatility of owning shares is somewhat greater than owning cash and bonds, for example. So you could lump all equities into the sort of asset class basket because they typically have higher returns over time and higher volatility of returns vis-a-vis something like cash and bonds. And the other aspect of that, these are securities that tend to do well together in certain types of economic environments. So when the economy is doing well, corporate earnings are rising, interest rates are rising, you may see that equities in general are doing okay, equity prices are rising, whereas something like bonds, so like fixed rate bonds, and the nature of those are that the capital value of those bonds may decline when interest rates are rising. So there's an example where bonds aren't doing well, but equities are doing well. And similarly, when you have an economic downturn, central banks start cutting rates, interest rates are falling, bonds will do well, but equities not so well because corporate earnings are declining. So again, that's how you would distinguish bonds versus equities. They perform differently, typically, different types of economic environments. And so you can define an asset class by collecting groups of securities, be them bonds or equities or even bank deposits, according to how similar their risk and returns are over time. So, for example, diversification. An asset class is different from a company share. So, some people may say, "Oh, I have a diversified portfolio. I have Commonwealth Bank, I have Westpac, I have BHP." What you effectively have is a whole bunch of different company shares, but they're all within the one asset class. They're all within equity. So, in fact, from an asset class point of view, that is not a diversified portfolio. That is a all equity portfolio. And as a result, when equities do well, all of those typically will tend to do relatively well. But if you have a bear market and an economic recession, then even the best companies' share prices tend to go down in value or don't do that well. So that is a big distinction. Asset class diversification is different from just having diversification by owning different types of company shares. As you can see on the next slide, there are lots of different types of asset classes. The most well-known is, of course, equities. You can almost treat globally. Typically, global equities are treated as a separate asset class from Australian equities. There's different types of sectors involved. Look, they do broadly can act similarly over the global economic cycle, but nonetheless, you'll have periods where equities globally are doing better than they are in Australia. So the correlation between the two isn't perfect. Different ones, and the ones we'll be focusing on today are things like cash and fixed income, as well, which are a very big difference, and commodities. Just on the next slide, this is just a slide of different returns across, again, different types of asset classes. So cash is considered a separate asset class. So that is like bank deposits, for example, cash at the bank, or very short-term bank bills, short-term financing paper by the companies do in the very short-term money markets, but effectively it gives you a very stable return over time. Then you've got bonds, Australian and global bonds. A-REITs is listed property. Australian equities, I'm as sure as we all know, like the ASX 200. World equities, so the collection of global equities, Australia, US, sorry, not Australia, US, Asia, Europe, emerging markets, all collectively seen as global equities. And then a commodity, as an example, is gold. And so what you will see here is, they're all performed differently. Well, returns aren't all the same all the time, as you would expect. And if you look at it over that 17-year period, you've had 3 years in which Australian equities had a negative return, 3 years where global equities had a negative return, whereas no cash and bonds over that period didn't have a negative return. So you can see less volatile than equities. And as you can see, there are also times when equities are doing well, is not the times when bonds are doing well. There is that low correlation in return. So again, getting an exposure to all those different types of asset classes in a portfolio can help build that diversification, help make your portfolio resilient in the face of different types of economic shocks over time. So why blend across asset classes? I think I've kind of touched on this a little bit, but again, if you think about it, so again, let's just boil it down to say equities on the one hand and cash on the other. Equities, higher return, high volatility. Cash, typically low return, low volatility. So by blending those two, you can basically come up with a portfolio that gives you a level of return and risk that you're comfortable with. So you can you can blend the exposure to equities and cash to give you an overall portfolio, risk return profile that you're most comfortable with. So it's not you don't have to go all cash or all equities. It's that ability to blend and calibrate that is important. So that's the first point, that finding that risk profile, blending to achieve a risk profile that you're happy with. But the other advantage is that, again, the fact that the returns on different asset classes aren't perfectly correlated. So when equities are doing well, bonds aren't typically are doing well, so they have a negative correlation. You get what's called an enhanced risk-adjusted return. So for a given level of risk, you actually can get a better return over time when you blend two assets that don't perform well at the same time, but they're not perfectly correlated. So a couple of real-world examples of that. I've given two examples here. One is like wine, for example. And you think about blending different. So why do people blend wines? Wines of different varieties, because you can actually come up with a taste that blends, degree of sweetness, degree of dryness that is best suited to different types of palates. And so a Merlot, for example, is a fairly sweet red wine. The Cab Sauv is a fairly dry one. So you can have all Merlot or all Cab Sauv, or you can get a blend of the two and come up with a wine, that meets your palate. So that's a similar type of thinking in terms of blending asset classes within a portfolio. So that's that calibration argument that I mentioned. The second one is this beauty of diversification. So if you think about two different businesses, one selling hot soup and one selling ice cream. So typically in the summertime, there won't be great demand for hot soup, so sales aren't particularly great, but in the summer, demand for ice cream will be quite strong. So if you just had one of those businesses, it would be a feast or famine. You get 6 months of good sales and then no sales, and vice versa. So if you blend those two businesses together, you get a more steady sales profile through the whole year. So you're getting less volatility in return, but for a similar return, if both businesses can generate, say, a 10% return over the year, by blending the two, you're still getting that 10%, but with less volatility in those returns. So yeah, that's that idea of blending different types of things that perform differently at different times over the cycle. So I hope that's clear and sort of why this is so advantageous to be blending. And just I guess a more academic type of a look at it. On this chart, you've got the risk and volatility of returns on the x-axis, expected return on the y-axis. And typically in finance, assets that give you a higher volatility of return, to hold those, investors demand a higher return over time. And so you get that risk return profile. So you can go have a point like A, which is something like cash or government bonds, or a point like B, which is high risk equities, emerging market equities. And so, but the beauty, if you blend exposure to those two assets, you don't end up with a point along that AB line. You actually can end up with a point higher up on that C, like at point C. So if you compare point C to point A, it's giving you a higher return for the same risk. Or if you compare C to B, it's giving you, so you compare C to B, you're getting a similar return, but for lower risk. So that's that beauty of diversification, what that achieves. So some investment examples there. Again, I've mentioned equities versus bonds. Bonds generally do better when equities are performing poorly. So during a time of economic downturn where corporate earnings are weakening, central banks are cutting interest rates, the capital value of fixed rate bonds tends to go up when interest rates are going down. So you get that negative correlation. Another one is Australian versus international equities. Again, in Australia, we tend to be top heavy in resources and banking stocks and relatively low in exposure to areas like technology. And so when there's a tech boom globally happening, our market is going to tend to underperform, as we've actually seen really in recent years since the GFC. When there's a resources boom going on, as we saw prior to the GFC, the Australian market can do pretty well. So by blending exposure to both Australia and international, you're getting some exposure to all of those areas and reducing the volatility of returns over time. Just going through it in a bit more, so just go through some specific asset classes I mentioned. So again, a key part of a key part of any diversified portfolio is some allocation to cash. It gives you a pretty low, yes, it does give you a relatively low return over time compared to, say, equities, but it's that stability of return that is quite good. So here's just an example of annual returns from cash. The bank bill, the typical return in the financial markets from cash is from something called the bank bill index, which is a measure of short-term financing between banks in overnight markets. But another way to think about it is it's similar to what you get from bank deposits. So the AAA ETF that forms part of our diversified ETFs that we'll be talking about, my colleague will be talking about, basically is an ETF that gives you exposure to bank deposits. And at the moment, it's offering you a yield of around about 50 basis points or 0.5% above the RBA cash rate after fees, so something like around about 1.2% or so. The other one along the risk return spectrum is fixed rate bonds. And again, a bond is basically, it's different from an equity. So a bond, when a company, if it wants to raise money, can let's focus on the company for starters. If it wants to raise money, it can issue equity, so you'll get a share. Then you get a part of you get share ownership in the business. You can get dividends, and you benefit from the capital growth and the market value of that company over time. But if that company were to run into trouble, shareholders can get wiped out. They're up, they're sort of right up the bottom of the credit chain. So when you need to divvy up the assets of the company, shareholders are the last people to get paid off. So you do take that higher risk. Company can also issue bonds, and these are basically, the issue with a bond is you don't get share ownership, you don't get any ownership exposure to the company. The yield you'll get tends to be a little bit lower, but it's a more contractually guaranteed fixed income, regular income payment you get from that bond. And again, if a company were to get into trouble, bondholders get paid off before shareholders, and so you're getting you're less exposed to the financial, there's less credit risk associated with that when you invest in a company bond. And governments also issue bonds. So governments don't issue equities, but they do issue a lot of bonds, so like government bonds. And so you're getting a regular income payment by holding that bond. Now, the feature of bonds is that the nature of a fixed rate bond is when you issue a certain bond, you're getting a regular nominal income payment from that bond. So as a result, when market interest rates decline, the market value of that stream of income that bond is producing goes up in value because you discount by less. And similarly, if interest rates go up, the market value of that future stream also the present value of that future stream of income tends to go down. So bottom line of that is the capital return on bonds, the market value of those bonds can vary over time depending on how interest rates move. But the interest income you get from the bonds is relatively stable. So in Australia, investors you can buy a single bond as you can buy a single equity, but you typically through an ETF you buy a collection of bonds, a bond index. And the chart there just shows you the returns from what's called the AusBond Composite Index. So it's a collection of all the bonds issued in Australia, both from companies and from governments. And as you can see, the income return, the annual income return from that index has been relatively stable over time. The capital value can bounce around. That's the grey one. So again, as I mentioned, when interest rates go up, the capital value tends to go down. But the variation of that return is still not all that great. It's plus or minus 5% or so on an annual basis, or it has been. So that's the nature of a bond return. A little bit more volatile than what you get from cash, but in exchange, you're getting somewhat a higher return by owning bonds as well, and we'll go into that a little bit in detail. But the other advantage of owning bonds, as you can see from the next slide, is that negative correlation with equities, most clearly recently seen during the GFC, as in that shaded area. So at a time when equities, during 2008, for example, when equities had a 40% decline, the Australian bond composite, the index of Australian bonds, actually gave you a return closer to something like 15%. So quite a strong positive return. And that's because interest rates fell and the capital value of those bonds went up. And similarly, so when the market rebounded the following year, interest rates, bond yields went up. You got a bit of a capital offset from those bonds, but the income return more or less offset that, so you got a fairly flat return from bonds. But as you can see, over that period, at least since 2003, there's been no period of a negative return from bonds, but the degree of which that return has tended to be negatively correlated with equities. So that's cash and bonds. And the other one is, if you're looking about the equity market, you know, again, the beauty of diversification is having some exposure to global shares vis-a-vis Australian shares. And just to, again, show by way of example there, the benefits of that. So if you look at something like the NASDAQ 100 index, which is a tech-heavy US index, we do have an ETF that tracks that index incidentally, the NDQ, but also S&P 500, which is, I guess, the benchmark American equity index, large cap equity index. As you can see, information technology, the NASDAQ is 47% exposure to that as at the end of last year. S&P 500, 23%. In Australia, only 2.5%. So we have very low exposure to technology. By contrast, we have a large exposure to financial, something like 30% as at the end of last year, versus virtually nothing in the NASDAQ and only around about 13% in the S&P 500. So again, just and resources are similar. You know, not a lot of materials exposure in the US indices, whereas something like 18% exposure in Australia. And as you can see over time, you do get less than perfect correlation between Australian and international. So that chart is basically the global index returns over time, and the bottom line there is the decline, what's called the drawdown. So the decline in the equity index, global equity index, from its peak levels vis-a-vis what's been happening in Australia at the time. So you can see there's been periods where the Australian market has fallen relatively heavily. During the late 1980s, for example, we had a pretty heavy market downturn when we had a commercial property crunch and interest rates were up around 18%. Globally, equity markets didn't fall anywhere near as much. During the tech crash of the early 2000s, again, because of our low tech exposure, we didn't fall as much as global markets. So there's an example where we did better. So there can be times, depending on how sectors are performing globally, where our market will do better or worse than global equities. So again, so that's a reason to have a bit exposure to a bit of both. So really, that's just giving you a high-level sort of view about why it's important to have a diversified portfolio, not putting all your eggs in one basket, being able to calibrate the risk profile that you would like, be it high risk, low risk, or medium risk, and through that process also actually giving you enhanced risk-adjusted returns, because it helps reduce the volatility of returns relative to the return that you're giving up for that benefit. So that's the underpinnings of it. In terms of using ETFs to get that, again, you can go out and buy individual equities, you can buy individual bonds, put them all together. Again, the beauty of ETFs is that it's now all available easily on the ASX. Won't spend a lot of time on this for those that are, but just for those that may not be familiar, what is an exchange-traded fund? It's a managed fund that you can buy and sell on the ASX, just like a company share. So it gives you, and it's a fund, so it gives you diversification across a range of different securities, be they equities or bonds. It has the same sort of investor protections as a regulated, any other regulated managed fund. Importantly, the assets within these funds are ring-fenced from the balance sheet of BetaShares. So were anything to happen to BetaShares, your funds would be separated and not be affected. Ease of access, you can buy and sell them on the ASX. Unlike a listed investment company, they're designed to trade at their net asset value. So again, if it's an index that's tracking, say, the ASX 200 index, if the market goes up 10%, the value of that ETF that you can buy or sell on the exchange should go up by close to 10% as well. It's not going to trade at a discount or premium to the value of the market. And typically, you'll see these are passive, rules-based types of exposures, and so relatively low cost. And we'll talk about the fees of these ETFs later, but they're pretty low cost. You know, less than 0.5% in most cases. In some cases, less than 0.25%. ETFs offer lots of choices. Again, all across all the different asset classes, as Sarah mentioned, we have exposures to equities, international equities, bonds, cash, and some of which do form part of our diversified portfolios. A point that will be mentioned later, but I'll just mention it here. Again, one of the unique features of our ETFs that we're bringing to market here is that it's not just BetaShares. A lot of the building blocks within these portfolios will be different asset classes and ETFs of asset classes provided by BetaShares, but not all. So where we found, you know, very low cost, good global diversification in other markets, other exchanges, we've used those as well, and so that's an important advantage. Again, and passive makes a lot of sense in many cases. Just a chart here, how active managers on average do struggle to beat benchmarks, and so all of the ETFs and the exposures within the ETFs all the asset class exposures within the ETFs we're talking about today are passive. There's no active element here where we're trying to beat the market and charge, you know, charge a high fee as a consequence. They're passive, low cost, and as you can see, over a period of 3 years, 5 years, 10 years, most surveys show that active managers do struggle on average to beat these various asset classes anyway. You know, there's a good case to stay passive, certainly for a core part of your portfolio. And again, we're not saying these are necessarily a be-all and end-all, but you can have a core part of your portfolio in a low-cost, passive, diversified ETF. And then if you do want to go active, you can sort of have satellite types of exposures as you may wish. But our aim here is to keep it very low cost, and a very simple passive types of exposures. ETFs, very strong growth in our market. You know, we're now at 10 billion funds under management. Overall, the market is, you know, pushing up toward 60-70 billion dollars now, and you know, very rapid growth, and so it's being widely adopted. With that, I will hand over to my colleague, who will go through the ETFs we're bringing to the market in more specific detail, Alistair, and thanks very much for your time.
Thanks, David. So just really trying to bring in together everything David's covered. We felt you've got the benefits of ETFs as a whole, where people may use them on an individual basis, but a really, really key feature we feel is the diversification that's required within portfolios. So here at BetaShares, we've looked to put together a range of diversified ETFs. These give you access to a multitude of asset classes, thousands of securities across different exchanges across the world, including Australia. And all of this is wrapped into one ETF that you can trade on the ASX in one single trade. So really, really easy to access. Just looking on the next slide. Obviously, when you're putting together portfolios such as this, you can't just do it willy-nilly, changing things whenever you see fit. We've tried to do these in a really rules-based approach, looking at what's known as a strategic asset allocation. So reviewing these on an annual basis and rebalancing quarterly to really strict rules. The investment strategy that and there are 4 ETFs across 4 different risk profiles, but they look to track a different risk profile using a multitude of ETFs within those of low cost, which aim to track indices. So they're all passive ETFs within the portfolios as well. Just looking at those 4 risk profiles, with this in mind, when you're looking to select a diversified ETF, you have different risk profiles ranging from conservative with an income tilt, right the way up to high growth. And these portfolios will be of a different tilt between the defensive or cash and bonds that David mentioned, and more growth assets on the high growth, which tends to be more of an equity exposure across Australian and international markets. These will match different investors' risk tolerances. Those on the conservative will naturally have an aversion or be less inclined to accept volatility of their portfolio, and those on the higher growth will not mind the volatility so much and be looking for higher returns over the long run. Just looking across at the next slide, it's worth touching on who these different portfolios might suit. When you are trying to select a different risk profile as an investor, looking at what the objectives are of this portfolio, whether it suits what you're trying to achieve. Obviously, these are all general information in nature, doesn't take into account your individual circumstances, but to give people a few ideas of which ones may match which objectives. Just starting with the conservative income ETF. This is probably for investors who have potentially a shorter investment time frame. The volatility of the portfolio is going to be lower by objective, more assets within cash and fixed income for those who may not be able to recover from major drawdowns through economic crises, as David mentioned. Looking just slightly up the risk profile, the diversified balanced ETF, potentially for those in the accumulation phase, you have more growth assets, people still trying to build a bit of wealth, but potentially approaching retirement. They may require some income. Again, not necessarily with the decades and decades of investment horizon that's there. So just moving slightly up in the risk profile with more growth exposure. Naturally, we go further up the profile to the growth ETF. Now, this has a majority of growth assets, so you will naturally have a higher volatility through the portfolio if you're looking at historical data. This is for those with, and you can see the recommended time frame moves up in the number of years here, because the longer time frame you have, the more time you have to recover from volatility and end up in a higher place than you were at the beginning of that drawdown. And we move up to high growth, and what happens is the pie chart just shifts. You have a larger exposure. This moves up to 90% growth assets, still with a 10% allocation to defensive. This can have a really important place rather than going entirely to risk assets such as equities. That 10% allocation with a little bit of cash, a little bit of bonds has actually enhanced risk-adjusted returns without necessarily making people miss out on upside. So it's a really, really important feature, that small 10%, rather than having a full 100% equities portfolio, we feel. Just looking under the hood and going through the portfolios one by one, again, just starting at the bottom of the risk spectrum, the BetaShares Diversified Conservative Income ETF. This is available through the ticker DZZF, so exactly the same as all of our other ETFs, has a ticker there that you can access on the ASX. You can see a pie chart on the right-hand side. This has a target asset allocation of 25% growth and 75% defensive, and that defensive is predominantly made up of Australian bonds. The features within this portfolio, including the ETFs and asset classes, are focused on trying to build as much income as possible from those. We've typically found that those investors who are more risk averse or maybe later in their investment cycle do require higher amounts of income from their investments, as opposed to investing in some of the high growth stocks, which don't pay as high a yield. If you're in retirement, naturally you may have bills to pay from your investments rather than the regular income from your job. So this is an important feature of this ETF or diversified ETF. And you can see the fee here, and this is consistent across all four of these, is 26 basis points, so 0.26% per annum. Moving up to balanced here, very, very similar in nature, but you'll see that it's a 50% growth to 50% defensive allocation. Cash making up 10%, and then you have Australian bonds, Australian property, and Australian equity, and then global equities, they're involved as well. Again, at 26 basis points, 50-50 split between growth and defensive. Growth moves up to a 70% allocation to equities and property, and then 30% is in those cash and fixed income. Again, just leaning more towards people looking for wealth accumulation rather than maintaining that fixed cash balance within their portfolio, and those are less averse to the volatility. And finally, the high growth ETF, as I mentioned, 90% growth, still with that 10% defensive allocation to cash and some bonds that just provides those stable cash flows. Actually, if we look under the hood and just taking the balanced ETF as an example, many of these have similar holdings within different weights, but you can see here, and as David mentioned, a really important feature of these ETFs is whilst they do hold many BetaShares ETFs, particularly where we have what we feel the best ETF on offer on the Australian market, as an ETF structure, it enables us to access ETFs which are listed on, say, the US market. And just like an individual ETF holding international assets, again, touching on the NASDAQ 100, for instance, these can be structured exactly the same, just holding US listed ETFs as opposed to the US listed stocks within, but still maintained as an Australian domiciled fund. So just looking through, we have cash through our AAA fund, some floating rate bonds and fixed rate bonds from BetaShares. We have a Vanguard global aggregate bond, that's international fixed income, just diversifying away from your Australian bonds and moving into the Australian sector. So A200, obviously an extremely low cost solution there, the lowest cost Australian equities ETF in Australia. And then you're moving across to those which are listed on the US markets, which can offer these diversified exposures for a really, really low fee. And it's through this methodology that's enabled us to make these diversified ETFs the cheapest on the Australian market, so passing on those benefits to investors who are looking to use these and diversify across different asset classes, but also different ETF providers. You can see here some historical performance. Now, this is simulated, and it's important to remember that historical performance is not necessarily an indicator of future returns, but it does give an idea of how these portfolios have performed historically if they were in existence through a simulated backtest. You can see in the red line there at the top, that is the high growth portfolio. And as you would expect, a higher growth profile, but it does have the highest volatility. If you compare it to the black line at the bottom, DZZF, or the conservative income portfolio, that has had a much, much more stable return profile. Investors wouldn't have suffered the same levels of drawdown, but over the long term, those returns have been lower, if not more consistent. There's a table in the bottom right, and that bottom part of the table, you can see the volatility over the last 7 years, with high growth of 8.26%, and that's what's known as standard deviation, or your returns that vary away from the average over time. And then you have the conservative, which has got about a third of the volatility of that high growth portfolio. So these have been designed to meet the objectives of different investors. What are they looking to prioritize? Is it a stable return profile, or are they prepared to take more risk in the hope of getting higher returns over the long run? Just looking at some of the benefits of these, why would you use these BetaShares Diversified ETFs? A number of the benefits that David touched on individual levels, these all flow through to these. You're accessing extremely low cost portfolios, and the underlying are extremely low cost there through passive ETFs across a range of exchanges. But the key is that instant diversification. These enable you to access multi-asset class portfolios holding thousands of securities in a single trade, and these are across different exchanges around the world. One real benefit to this is if you are looking to make regular contributions over time, build up your wealth, These enable you to do that in a single trade rather than, even if you had a portfolio of 10 ETFs, you're paying brokerage on 10 different trades. If you're looking to build up and make regular contributions, you can bring down your brokerage charges, or even accounting fees can sometimes be done on individual lines. So these are a really good way, particularly for low balances, adding regular contributions over time to enhance that efficiency. How can investors use these ETFs? That's an important question. As I mentioned, we've centered around these being an all-in-one solution, a one-stop shop. If you are just looking to build a robust, diversified portfolio that covers a multitude of asset classes, these can be that one-stop shop. There we have a strong risk management process that is designed to meet these objectives of different risk profiles. As you may become more sophisticated, there is the opportunity to use these as more of a core within portfolios, and then you can add some things around the sides, whether that's other thematic ETFs or managed funds or direct stock holdings. You can personalize your portfolio, look to gain some outperformance compared to traditional benchmarks. They can also be used for grandchildren and children. If you're looking to start off with investment portfolios for other members of the family, again, a really easy way to get them started, familiar with investing, familiar with different asset classes and diversification. And then just finally, really important things to consider. As with any investment, there are risks associated with these across all of those risk profiles. We really recommend that you speak to a financial advisor before making any investments, but all of the risks are laid out in the PDS, the product disclosure statement. But a few of them, you naturally have market risk, you may have currency risk from those international exposures, the underlying ETF risk, and index tracking risk. These ETFs aim to track an index. The risk is that they may not do that, but these are all standard risks associated with ETFs, all of which are listed in the PDS. Important to remember, all of this has been general advice in nature, does not take into account your personal circumstances. Please do your own research before making any investments.
Thank you so much, Alistair. And if you do have any questions, please type them through. There's quite a few on the board, so we will get to them. And just a reminder of our upcoming webinars before we start taking questions. Is emerging markets on your radar? On the 5th of March, we'll be joined by our partner Legg Mason, going through our EMMG update, talking about emerging markets there. And then also a very popular webinar, we'll have David Bassanese's quarterly economic webinar. The title for that one is Fire and Flu. So a really interesting start to the year, lots going on, and David has quite a lot to talk about, setting the scene for the investment landscape 2020. Now, just to come back to some questions, quite a few product questions, Alistair, so I'll start with you if that's okay. Just in regards to the sort of fees, so if an ETF is holding multiple ETFs, does this mean that you're paying multiple management fees?
No, so that 26 basis points is an all-encompassing fee. So that takes into account those fees paid to the ETFs. Actually, the BetaShares ETFs held within the portfolio, that fee doesn't come out as a separate fee. That is rebated essentially. But that 26 basis points is the full fee that you would be paying on per annum. And that naturally comes out of performance automatically. You're not paying an annual subscription. You're not paying on entry. Any performance you see through the unit price changes or the change in the net asset value will have taken into account that fee. An easy way to think is it's $26 per 10,000 invested per annum.
Yep. And so Clifford here is looking for probably product specific and something that is away just from diversified, but looking for something ethical, sustainable, solar, wind, and alternative energy. Does an asset class exist?
Absolutely. This has been, you're not alone there, this has been a huge, huge focus from investors, incredibly topical at the moment, as you would imagine. We at BetaShares actually have 3 different exposures across multiple asset classes that are predominantly focused on what's known as environmental, social and governance investing. On the Australian equities side, we have the Australian Sustainability Leaders ETF, known as FAIR, or the ticker is FAIR, F-A-I-R. We have a global exposure as well, the Global Sustainability Leaders, available through the ticker ETHI or ETHI. Now, both of these funds are equity focused, but look to prioritize those companies which are in line with responsible investing standards and sustainable leaders within their field through climate efficiency measures. The full methodology of these funds is available on the website. Rather than me going into great detail, it's important to note we have more recently launched a diversified bond ETF in the sustainable investing side, which is both encompassing global bonds and Australian bonds. Now, these are green bonds on the international front, which fund projects that are to do with, for instance, climate efficiency by governments, and then those bonds in Australia, which are screened for responsible investment screens. Like I said, all of this information is available on our website. I highly recommend you checking those out.
Yeah, absolutely. Such a hot topic, ethical investing at the moment. Now, coming back to our diversified suite, these are an evolution and may have been available overseas, but very recently have come to the ASX. And a question here is, how would you differentiate so BetaShares Diversified ETFs versus some of the other product providers that may be also available on the ASX?
Yep. So the key one, which we touched on, is really down to that diversification across different ETF providers. When you're using a BetaShares Diversified ETF, you're not only exposing yourself to BetaShares funds. We use ETF providers from across the globe looking to get the best outcomes for investors by lowering those underlying management fees. Through that, you will see that these are the cheapest diversified ETFs on the Australian market. And that's something we've been able to pass on to investors by using this methodology. They would be the key standout features, I would say.
Yep. And just a question just about the bond exposures in the portfolios. Are the bonds contained in those ETFs weighted?
Are the bonds weighted?
Mm-hmm. So it's made up of different bonds. How are they sort of weighted?
Yes, absolutely. Each of the fixed income ETFs will have a separate index methodology. We have 3 bond exposures on the Australian side. So starting with floating rate bonds, these are weighted across Australian banks, but there is a higher weighting to the big 4 banks and then a lower weighting to the regional banks. Then you move into Australian government bonds and corporate bonds, but within these, as a total portfolio, we will weight these in allocation to where we see the benefits lie. I'll pass on to David, who's involved in that investment committee as well.
In terms of the bonds?
Yes, and how they're weighted.
Yeah, look, I guess at the end of what we've done is we from a strategic point of view, we've weighted bonds so that we broadly match the what's seen as the benchmark index exposure in Australia, the Ausbond composite. So if you look at it there, we do have different ETFs giving you exposure to floating rate bonds, government bonds, corporate bonds, something like 12% exposure to long duration Australian government bonds, 6% exposure to long duration corporate bonds, about 6% exposure to floating rate. By floating rate, it means it's no duration at all, so it's not sensitive to where market interest rates go. So the net effect of all that is to give you an exposure that is broadly matches the sort of the benchmark Australian index in Australia, the Ausbond composite.
Thanks, Dave. So another question here is, how do you actually find out what shares are within the ETF? And I guess one of the great things about ETFs is their transparency, and all of the individual shares contained in a ETF is available on our website. On the fund page information, you can actually download a list of portfolio holdings contained in those individual ETFs. So for NDQ, the NASDAQ 100, you could actually go onto that website and download the 100 underlying shares within that ETF. So just in terms of rebalancing the portfolio, how is that done and how much notice is provided?
The portfolios are rebalanced on a quarterly basis. So on each year, the investment committee at BetaShares will formalise the asset allocation of these portfolios, and then on a quarterly basis, if there has been a more than 2% drift away from where those set asset limits have been made, the portfolios will be rebalanced. But a key objective of these is also to keep turnover as low as possible, minimize those tax events, keep them efficient for investors, but a quarterly rebalance so that, you know, if you've invested in a balanced portfolio, you don't want that drifting. If equities really outperform bonds over a period, your asset allocation could drift quite significantly. So these keep those in line with the objectives of those investors or those risk profiles.
Excellent. And I guess a question for you both is a great question actually, and one that we've had a few times, but nonetheless still very good. What has caused the massive increase in range and specialized ETFs in the last 5 to 10 years? Before then, we only had broad market index trackers. It's all seemed to go very quickly. So a question and a comment.
Well, I mean, I guess it's responding to market demand. I mean, again, the beauty of ETFs is such a great structure, and that, again, easy access to these broad investment benchmarks on the ASX, typically low cost. And so, you know, all the big major asset classes are now well covered by ETFs. And I guess as demand, people are now getting familiar with ETFs, using them a bit more, looking for more nuanced niche exposures. There's been demand for other types of ETFs coming to the market as well. So we're just seeing, you know, growth there. So, you know, it's a brand new way of investing. It's a top-down global macro style of investing that's opening up not only the Australian market, but global markets. So, you know, again, we've just recently launched an India ETF. So you can now invest get exposed to Indian stocks from the comfort of your you know, share trading account through CommSec or whatever on the ASX. And so it's just reflecting that demand and the opportunity, the uniqueness of this structure.
Yeah, absolutely. And diversified ETFs, just a further evolution of that all-in-one simple access. A question here is, and we've got a lot of international in some of these funds. So how do you know, Alistair, for you, which one is hedged or unhedged in an ETF?
Yep, so typically, for all BetaShares ETFs, it's within the name of the fund. So you'll see the fund name and then a little hyphen, and it will say currency hedged, if so, after it. For international ones, this may be the case, so for some of the US listed, but if you go on their website, they will clearly state whether the fund is hedged or not. Within these portfolios, the majority of funds are not hedged. We have maintained that currency exposure outside of the global fixed income, where your currency movements can be far more volatile than the underlying. So currency hedging is a basic practice on those sorts of exposures typically.
Thank you. Time has gotten away from us, and there are more questions which we will look to follow up on. As a reminder, all registrants will get a copy of the slides and a recording of the session today. We do apologise for the little hiccup at the start of the session, but rest assured we are really excited to be back with our webinar program in 2020. As I mentioned, we've got 2 really exciting webinars coming up at the start of March. One about emerging markets, and the most popular David Bassanese quarterly economic webinar. So please keep in touch. We look forward to seeing you throughout the year. And as always, any feedback, comments or questions are always helpful and appreciated. Thank you very much.
Bye-bye. Thank you.